Hello, everyone. Today on the Final Bar, I'm joined by Clint Cowles from TD Ameritrade Institutional. He's going to share with us some of the charts that are top of mind for him as we think about how to navigate this fourth quarter. We're here in October, the beginning of earnings season, which could be a pivotal one where we start to gather some information about what these companies are doing recently and what that could tell us about prospects through year, and particularly the financials, where we've seen a lot of announcements this week. We'll break down each of those charts together here in a bit. Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to the Final Bar. This is Dave Keller, Chief Market Strategist here at StockCharts.com in a rainy Redmond, Washington. Thanks for joining us every weekday after the close as we focus on the markets, the message that the markets can provide back to us. If you went to business school, you were probably taught analyze the companies, analyze the economy, and then the price tells you what is happening after that. And what I learned as a technical analyst is you can focus on price. There's actually information embedded in price. It's interesting, early on in my career in the early 2000s, that was sort of a not a mainstream perspective. The growth in hedge funds, the growth in individual trading, a lot of different things I think helped to proliferate technical analysis, particularly the growth in the area of behavioral finance, and also studies on price momentum. There's a thing called the momentum factor, which validates a lot of the charts that we're going to be looking at here in the show and every day on the show. These are things that technical analysts that came before me have well known, but now we're able to validate why they make so much sense, the information that is embedded in price itself. And I think particularly when we're looking at something like bank earnings, focusing on the charts and what they can tell you about how investors are interpreting earnings releases, anticipating what's coming from these companies, can be very, very illuminating. Our schedule, a lot of great guests coming on the show. I'm excited to talk to Clint Cowles again here. He's been on the show before, and it's always great to get his take on things. Tomorrow on the 14th, we have Jeff Huge from JWH Investments, so a Minneapolis theme here to the week. Next week on Tuesday the 19th, we have Katie Stockton from Fairlead Strategies. On Wednesday, Mish Schneider, co-founder of Market Gauge. And then on Thursday, Craig Johnson, technical analyst at Piper Sandler. Also, a couple quick events to point out to you. Friday the 15th, we have our follow-up session. We recorded an event back in March called Chart Madness. And if you go to StockCharts.com/Chart Madness, you'll see the event that we did. You can watch the video right from that page. We're going to revisit it. Tom Bowley, Greg Schnell, Grayson Rose, and I all picked a bracket, picked our winners of the 16 names, voted on our final four and our top stock with prospects. And now we're going to look at the 7 months that have played out since then and talk about what actually happened, what we learned from the markets then. Also, I will be doing my next webcast from Market Misbehavior called Buy in October, 5 Charts to Follow. You go to marketmisbehavior.com/October. You can sign up for that free event. It's coming up next Tuesday, the 19th. Talk about 5 charts I think that will be key to follow in the month of October to make sense of this market and see if we do get that acceleration to the upside that I think could be in store. Let's continue on today's show with our market recap. As I mentioned earlier, it's actually sort of a choppy session, and there's a sell-off earlier in the morning, and by the end of the day, the S&P had regained positive territory, 0.3% higher than where we closed yesterday, with the S&P just below 4364. The Nasdaq and the Nasdaq 100 both up a little more than that, up about 0.7 to 0.8%. The VIX, by the way, is back below 20. It's around 1850 today. Other asset classes very quickly. So we had bonds closed on Monday. Yesterday, we saw yields coming off, and we saw further deterioration in interest rates today with the 10-year yield ending the day around 155. Overall, still very much elevated from where it's been. I mean, if you think about this rotation from 175 earlier in the year down to 115 or so, a couple months ago, and now we're rotating back to the upside. And I think we're in that range, that 150 to 175 range, which is pretty important. It'd be interesting to see how rates are around that period, and especially this week as we get to a segment a little later called the bottom line, where we focus on earnings. We'll talk about some of the bank charts. JP Morgan reporting today. We have Morgan Stanley, Goldman later this week. We'll look at some of those charts, but a lot of the banks, particularly the regional banks, it's a play on interest rates and it's a play on the yield curve, and rates remaining elevated, and certainly the 10-year breaking above 175, which I think is certainly possible, could absolutely provide a tailwind to some of those names where they haven't really followed through to the upside just yet. The dollar index, by the way, down about 0.5% using the UUP. Commodities overall stronger today, pretty much across the board. Gold and silver strong in particular, and the GLD rallying. Certainly, when you think of gold, you think of it as an inflation hedge. It's a common way to gauge investors' skepticism or concern with inflation and prospects for future inflation. The GLD breaking out, or at the very least accelerating a bit to the upside, it could be a key signal to look for. We're going to look at that chart here in a moment. Just want to touch on the fact that cryptocurrencies reverting back to the upside. So we had a choppy session after Bitcoin came off of all-time highs, just about 57,000, rotating, or not all-time highs, sorry, highs for the year or for the last 6 months, now rotating back higher, getting above 57,000 as we're recording here just after the equity market close in the afternoon. So Bitcoin 57,000 plus, continuing to show signs of strength, I think, overall, relative even to some of the other coins out there. Let's start with the chart of the S&P 500. I was interviewed earlier today on a couple of media outlets. We were talking about the S&P, and again, I love to keep it as simple as possible. That is usually my goal when we're looking at charts. And I think from a tactical standpoint, it's all about the trends of highs and lows, right? And you can see how there was a change of character sort of in the July, August to September timeframe when things started to change. The S&P had continued, it remained above its 50-day moving average pretty much 100% of the time, or very close to that in 2021. That changed in September when we finally broke the 50-day. We had made a consistent pattern, or a fairly consistent pattern, of higher highs and higher lows. If you look at the major price swings, that changed now. We're seeing lower lows and lower price highs. And so I think until that pattern changes, you have to be thinking in sort of at the very least tactical downtrend mode, right? A downtrend is a pattern of lower highs and lower lows. And even if with the bounce that we saw last week into this week, we're continuing to make lower highs. We're making lower lows, right? When we push lower, we're undercutting the previous support level. When we're rallying, we're not able to eclipse the previous high. At some point that changes. And in terms of what I would be looking for to suggest we may be in sort of an all clear scenario, that would be the type of pattern that would tell me that that stocks are starting to improve, and not just stocks. I think there are plenty of individual stocks that are doing just fine, but in terms of the markets themselves in the form of the S&P. Also worth noting at the bottom, right, the momentum had been very much in positive territory, never getting below 40 through the course of 2021. That changes in mid-September as we break below 40. We really haven't gone back above 50 from that point on. Seeing the momentum get back in positive territory, the RSI getting above 50, even 60 when we would rally, that would be the type of thing that would suggest to me that this sort of short-term pullback phase may be ending or near ending. I mentioned the chart of gold. I want to go there here very quickly if we could, because gold in general has been in a downtrend. And I would define, again, that downtrend in a couple ways. Very simply, lower highs and lower lows. And if you start the clock at the end of May, you can see this pattern of lower lows really didn't undercut the low on an intraday basis. We did on a closing basis there in late September, but really more of a double bottom here. We sort of hit that same level and bounced. But we've also very much had lower highs, right? And attempts to break that pattern, attempts to hit a lower high and then change that and get above the previous resistance have failed. Failed here in late July, failed especially in early September. And from there, we're now once again sideways. So we rallied quite a bit today relative to what we have done in quite a while. I would still point out the fact that overall the chart remains in a downtrend. What I would need to see to sort of change or to recognize that the trend in gold is most likely changed is the RSI breaking this pattern of sort of price bouncing, and the RSI hits a resistance around 60. That's really more classic with a bear market phase where the whole range starts to come down a little bit. It shows you that the momentum overall, there's just not a lot of buying power pushing prices to new swing highs. It's failing at new highs, and the momentum is remaining relatively muted. The rally today is pushing the RSI higher. I think getting above 60 would be an interesting data point to suggest that might be over. Getting above moving average resistance would be encouraging. Getting above that 172 level, which would take us above the July, August, September highs. That's what I would really need to see to convince me that that the trend is changing. And again, what does that mean? That certainly would suggest that while we've been talking about transitory inflation, meaning inflation is just a short-term thing, and then we'll sort of settle back down. Gold going higher tells you that there's a bit more of a concern, or at least it's pricing in more concerns about the prospects of higher inflation. Wrapping up our market recap, worth noting that even though the S&P choppy and moving higher, utilities the number one sector, up 1.2, 1.1, almost 1.2%, followed by materials, and then technology. On the downside, you had energy and financials. When we come back from the break, we'll have a discussion with Clint Cowles. After that, we'll do a segment called the bottom line, where we focus on earnings this week. And we did have Delta, which we'll look at Delta and talk about airlines as a whole, but particularly financials down today. And really, this could be the week where you see renewed strength on some of these financial charts that really have sputtered out. They've sort of been sideways, choppy, bouncing down from resistance. Is this the week where you see renewed upside for banks? We'll look at that and a lot more. Take a quick break. We'll be back with my guest, Clint Cowles. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. Thanks so much for joining us every weekday after the close as we focus on the charts. We try to interpret and really visualize the market activity through the form of charts and technical analysis, and using the power of stock charts to the best of our abilities. A couple quick comments before we get to today's guest, Clint Cowles. First off, we'd love to hear questions from you. We had a lot of fun with the mailbag segment yesterday, talking about some of the questions that have come up recently. We would love to hear from you, questions that are coming up as you are trying to use technical analysis to make better decisions. What charts are you struggling with? What charts do you feel are challenging? What indicators or approaches or market dynamics are you struggling with? Let us know, and we'd be happy to answer your question on the air. Our email is thefinalbar@stockcharts.com. We're on Twitter @FinalBarSCTV. We're on YouTube. Just go to our YouTube channel called Stock Charts. Put a comment below the video that you're watching. We'll gather all those questions, and we'll hope to answer yours on our next mailbag segment on Friday's show. Also, go to StockChartsTV.com. That's our on-demand platform. We put out so much great content every day. I enjoy doing the Final Bar, but there's so much else on Stock Charts TV. Great commentary, great hosts, great expert perspectives, and very much an educational bent to everything we do. So go to StockChartsTV.com, set up a free account with your email, or just search on any of the app stores using your mobile device for Stock Charts TV on demand. I want to welcome on today's guest, joining us on the show once again, Clint Cowles. Clint is coming to us from the Minneapolis area, Senior Manager, Institutional Trading Relationships at TD Ameritrade Institutional. Clint, it is so good to have you back. Thanks for coming on the show today.
Of course. Thanks for having me. Good to be here.
So as we were talking in the market recap earlier, sort of talking about this conditions, right? The long-term trend in stocks has certainly been encouraging year to date. But in the last 4 to 6 weeks, we're obviously seeing a bit of a pullback, right? And seeing some rotation. Start us off with chart number one, really looking at, I think, a risk on versus risk off. What is this telling you about the conditions here?
Yeah, so I've got 3 different ones here, and just kind of highlighting that it's not just kind of a one sector, one off, but really saying the same kind of thing. And I also marked with a vertical line on there what the actual top was in the S&P there. So if you notice, it was very close to that top in the S&P, or even a little bit before that, that these ratio charts really started to turn around, and the risk on sectors, like consumer discretionary, energy, and then the small caps there really started to outperform the risk off sectors. Now, if we drill down into those each a little bit further, you can see that during that sell-off portion, or over the last couple of weeks in the S&P 500, those risk-on sectors really didn't sell off. They just kind of went, more flat sideways, whereas the risk-off sectors, like the staples, utilities, they actually did have a bit of a pullback. So if we've got some of the sectors just going sideways and then some of them pulling back, of course, the aggregate is still going to have a pullback, and that's what we've seen here in the S&P. So the top one there, consumer discretionary versus consumer staples, that's kind of pretty classic risk on, risk off. The second one is maybe not quite as much or as popular there with energy and utilities. I started following that one when I was actually studying for the CMT, reading John Murphy's book on intermarket analysis. But the energy sector is usually going to outperform when the economy's kind of heating up and people are using a lot more energy. And utilities, definitely not so much. And they're actually a little bit more interest rates sensitive. So with the rising interest rates, maybe not the last couple of days, but over the last couple of weeks, that's kind of had them pulling back a little bit. As far as the IWM and the SPY, SPY has been on that uptrend. The Russell has been basically stagnant for almost 9 months, and it still is. Even when the S&P was pulling back, the Russell still stayed flat. So, if we're really looking to go into some sort of a bear market, which I've seen a lot of, there's definitely some people on CNBC and financial shows talking about. You'd really expect to see those risk-on sectors participating in that downdraft.
It's
I
so fascinating, and I appreciate the shout out to John Murphy, and I for so many of us, I know his work ended up being pivotal at some point. Most of us, as we were studying for the CMT exams and trying to get our heads around all these different charts and different relationships, it's so interesting how we think of this as risk on and risk off, and it's almost been inverse to the market, right? In terms of where the leadership has come from, particularly that XLE XLU ratio, which is a really interesting one we haven't seen a lot. I want to make sure we have enough time for your second chart here, looking at an Elliott Wave approach to the S&P. Can you talk us through this one?
Yeah, so from a much larger degree, we obviously had a big drawdown with the coronavirus back in early in 2020, but that turned around real quickly, and we've been stair stepping and having those higher highs and higher lows ever since. So really, we're looking for a full 5 wave progression here, and we're not even halfway through it. In my perspective here, based off the wave counts. So from a larger degree, it looks like we're still in the middle of a third wave higher, and from a smaller degree, we've got that fourth wave contraction coming back down. So this is the biggest contraction that we've had really since that second wave back at the end of 2020. So there hasn't really been a whole lot of volatility. So it's been nice to actually see that come in and give us that fourth wave, because after a fourth wave comes a fifth wave higher. So in looking at that, we are seeing some signs that it's starting to kind of finish up, maybe. And part of that being the ratio charts that we were looking at before. But I've got a MACD study down at the bottom, and the downward sloping trend line that it was using as resistance has been broken through. And then from the histograms perspective, we actually have a bullish divergence there. So those are not necessarily strong signals saying it's over, but they are indications that we are nearing an end. So like you mentioned before, we definitely need to see an actual reversal in that trend. We need a higher high and a higher low in order to feel pretty confident that that fourth wave is over, and then we can start heading up on that fifth wave up to new all-time highs. But we are seeing some of those indications. Based off of the potential target, once I think that fourth wave is over, that is really looking at the 161.8% Fibonacci extension of waves 1 and 2. So that's what I've got up there as to that potential target for the end of the fifth wave once we do finish up on our fourth wave here. Now, Elliott Wave doesn't take timing into perspective, so I mean that's kind of showing on November. That would probably be a little quick. I just have it there just so it can fit in on the chart. But eventually, I would like to see that fifth wave of the third finish up right around 4,900 there.
It's such a great take, and I love, and again, I love how with the Elliott Wave count, you're really able to illustrate the structure of this market, showing this long, impulse move from last fall to where we're at just recently, and what that prospect could be. And it's interesting how that lines up with the seasonal trends, right? Sort of weakness this time of year, and then strength through year end. Clint, listen, it's awesome to have you on the show. Thanks so much for bringing a couple charts, really helping nudging our thinking a bit. Stay safe, be well in Minneapolis. There, we'll talk to you again soon.
All right, thanks for having me.
That's Clint Cowles. Clint is a senior manager, institutional trading relationships at TD Ameritrade Institutional in Minneapolis. And as you probably know, if you've watched this show with any regularity, I don't bring up a lot of Elliott Wave counts on the show. And I will tell you, for my time working on the institutional buy side, I have never been a big user of Elliott Wave. I have always been a big consumer of people and experts that use Elliott Wave, because I find it is, if you are familiar with behavioral finance, and if you buy into the idea that the market moves based on the emotional conditions of investors, which I 100% believe in, Elliott Wave gives a little more structure to that, which is pretty valuable. Interesting to see, and what I always love is how it relates to what you're seeing in other methods. I especially like how that lines up with some of the seasonal tendencies that I alluded to at the end. That was a great take from Clint Cowles there. Let's continue on with our next segment called The Bottom Line. This is an attempt to sort of dig into earnings a little bit. And some of the StockCharts contributors, particularly Tom Boley, I think do a really good job of relating what's happening with these companies and their quarterly earnings reports and how that relates to the price behavior. And that's really how I would think of it. My friend Craig Johnson from Piper Sandler always talked about, he would portray it in terms of the PE ratio. We all are looking at valuations in some degree. If you're looking at a company fundamentally, you're looking at the E, you're looking at the denominator of that ratio. If you're a technical analyst, you're looking at the P, the price, the numerator in that ratio. But at the end, both of those are of value. Is a company able to grow earnings and our expectations growing, and the price tells you about the expectations and where people are thinking. Let's talk about some of the stocks that actually have reported. So this week we've got quite a bit in the financial sector. Particularly this morning, we had two that I wanted to highlight. First off is JP Morgan, and I'll bring up actually a different chart here. Let's see. When you look at the chart of JPM, you're experiencing what I would probably loosely describe as a failed breakout. When you think about JP Morgan and the basing pattern that you saw, sort of the rally into May, June, and then June, July, August, September, it's been sort of a consolidation pattern, right? And what that tells you is a change of character in the chart, right? If you look at the middle of this chart, you can see, depending on how you want to describe it, buyers are outweighing sellers, buying power is outweighing selling pressure, demand is outweighing supply, however you'd want to describe it. But at the end of the day, the price going higher tells you that the upside potential is certainly playing out and the prices are going higher. Look at how that changed, though, when you settle into an equilibrium mode. This is when buyers or sellers are essentially in agreement. This is where we all agree on where this stock should be based on its valuation. This is about, JP Morgan's worth about $155 a share based on where it's at. And that's been the case since March. Here in mid to late September, you see how that changed, right? When you have a basing pattern, then you break out to the upside. That tells you that maybe buying power is increasing. It's outweighing that natural selling pressure. Investors are willing to push the price above 165, which is where it had hit resistance before. But if you look at what's happened in the last week, starting to rotate lower. And it reminds me a lot of the chart of Amazon that had this beautiful 10-month base. We break out and then it kind of fails and comes down. Apple, as it breaks out of a pattern, kind of comes down a little bit and goes back into that basing range. And I think you're potentially seeing that same thing with JP Morgan. When I think about the potential for the markets to rally and perform well through year end, it would seem to me charts like JP Morgan, I'd feel much more confident about that thesis if charts like this are rotating higher and staying there, right? And the base is usually helpful to look at the breakout level and see if that level is able to be held, right? So a break above 165, very bullish. Holding 165 is kind of the key to that thesis. Now that we've broken back below there, you have to think, are we back into this range? Was this just a quick head fake before we come back in, a whipsaw before we come back into that range? And I think getting back above 165 would help to eliminate that maybe potential sideways to negative thesis given this potential failed breakout that we've seen here. So what's interesting about that is if you look at JP Morgan's release, not horrible. I mean, there's some interesting details in there that kind of outside the scope of what we can cover in a brief segment. But the fact that the stock is down this much on an earnings release, it was not that negative by any means, is a bit of a challenge. I think that presents some potential challenges for some of these other names reporting this week. BlackRock, on the other hand, actually bouncing higher. Now, if you look at this, JP Morgan had made a new high and then rotated lower. That's kind of what happened with BLK here in August, right? You hit a resistance level, you broke above it, and then we came back into this range. And now what's happening with BlackRock is you're testing support. We've tested support in June and July right around these levels, around we'll call it 825 to 850. We're sort of back bouncing off of those lows. Again, that's a clear support level. We're now testing the 200-day moving average, bouncing higher today. My question would be, can BlackRock hold those previous lows, that 825 range, and hold the 200-day moving average? That could be an interesting setup for a nice rally, particularly given a bullish divergence that you're seeing here. Lower lows, September into October, higher lows and momentum. Could be a nice vote of confidence in BLK. Delta is another one that was before the open today, stock down over 5%. Airlines have been a challenging space. We highlighted them when they broke above, stocks like Delta break above the 200-day moving average, the RSI getting in bullish territory. But just like we talked about with JP Morgan, I'm concerned when you quickly fall right back into that range, right? A breakout is a good breakout as long as it holds that breakout level. When it fails and it comes back below there, that tells you that the conditions might not be as positive as they appeared when we had that breakout. The question is, do we hold support, right? Do we hold the previous swing lows. Holding 37.50, absolutely crucial, I would say, to maintaining any sort of bullish thesis on airlines. Airlines have been a challenging space. These rallied when a lot of things are coming off here in mid-September. At this point, though, Delta coming off quite a bit. Now, other stocks we have coming up, quite a few. I'll highlight just one more, which is Morgan Stanley. This is, let's see, before the open tomorrow, if I remember right. You know, Morgan Stanley's a different one. So Morgan Stanley actually tested resistance around 105, hit there first in August, tested again in late August, early September, late September. And I would say if we do get a bounce here with earnings tomorrow morning, I'll be looking at that 105 level. That would be the question. Can it hold that? Can it get above that? If not, if we get an earnings miss, or if the earnings are okay, but the price comes off, meaning investors are not really rewarding Morgan Stanley for a decent quarter, which is, I think, what you maybe saw with JP Morgan, that would be an area of concern then, I think, for financials as a whole. Does the RSI hold 40 if it would pull back? That's what I'd be looking for there. That's our segment, the bottom line, focusing on some earnings releases. Again, it's a financials heavy week. We didn't get to talk about Goldman Sachs, Wells Fargo, Citi, others, and many more. So make sure you check out those charts if you can. We need to wrap the show. Go to the 3 and 3 charts in 3 minutes. Here we go. Boy, I hesitate to drop a point and figure chart as one of my 3 charts, only because I know I have about 30 seconds to talk about it. But I was talking with David Sato Chung at Investors Business Daily. Shout out to him and the good work that he and the team do. I've followed his comments on the markets for most of my career. And what we were looking at together was the point and figure chart on the 10-year yield. If you look, it actually gave a really meaningful signal here in January when it gave a sell signal. That's a column of O's broken by a second column of O's, basically indicating that the trend is following through to the downside. You then recently saw a buy signal, and again, it's sort of a buy signal for rates, a bullish signal for rates, a sell signal for bonds is how I would generally think of it. And this is a column of X's going above the previous column of X's. That clears the way to go back to 175, which is the resistance that we saw earlier this year. My question, of course, with the point and figure chart, does it get above that resistance level? And if so, that certainly clears the way potential for much higher highs. But interesting read on the point and figure chart, very simplistically illustrating the trend and the positive move that we're seeing in interest rates. Chart number 2 is JP Morgan. In our segment, the bottom line, we talked about some of the banks, JP Morgan, Morgan Stanley as well. And I think JPM it could be an interesting one. We talked earlier this week about Facebook pulling back to its 200-day moving average. Could be a great example stock to follow, to see if a stock like that is able to hold support as you might expect, is it able to bounce off of, and if not, does it hold that sort of 290 to 300 level on Facebook? On JP Morgan, it's a stock that has broken out of a base, but now come back into that range. Can it get back above 165 and stay there? And again, I'm concerned a bit as one of the first financial stocks reporting this week, with so many others coming through the remainder of this week, coming off quite a bit after their earnings report. That could be sort of a harbinger of negative patterns to come on some of those other financial stocks. Finally, I'm often asked for examples of stocks breaking out and stocks breaking down. I run these screens often for my own clients at Market Misbehavior, and Skyworks hit my new low screen today as I was writing a note to all of them. SWKS is a semiconductor stock. Semiconductors you think of as one group, and in general, I don't think that's necessarily a bad thing to do, but you're certainly seeing some divergences, right? Some of them are holding up okay and much better than others. Certainly others are breaking down, and Intel versus NVIDIA are 2 perfect examples, same group, but very different technical profiles. What concerns me about Skyworks, we had a resistance level in October, just above 150, call it 155. We sort of broke above that level in January, retested it in March, retested it in May. We bounced off of there about a week ago and now failed today with the stock down 2%. So a clear level of resistance that becomes support, that is validated multiple times over many months and then finally breaks. That's usually not a constructive pattern to see. That also arguably validates what you could consider a weirdly shaped kind of head and shoulders top. I don't know if I would call it that. That's probably not a CMT friendly way to label that, but I would say, a basing pattern of resistance and support that is broken to the downside is an area of concern. What's most concerning about a chart like this is the relative strength going down. And as we've mentioned many times, if you want to outperform the S&P, you need to own stocks where this line is going up, not where this line is going down. Folks, that is our show for today. Thank you so much for joining us every weekday after the close for the final bar. Special thank you to Clint Cowles from TD Ameritrade Institutional joining us from Minneapolis. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe, be well, have a great night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.